If you're a homeowner with a mortgage, you'll be wondering if interest rates are heading lower and when. This comes after the US Federal Reserve made its much anticipated first interest rate cut.
When the US Federal Reserve cuts interest rates by 50 basis points, we expect to see a similar 50 basis point cut in the mortgage interest rate over here in Singapore. So that would equate to an interest rate of 2.3%, from 2.8%. But from history and traditionally, it doesn't happen this way.
There is a close correlation between the federal fund rate and Singapore's benchmark interest rate, or SORA. SORA dropped almost immediately when the Fed first cut its rates on September 18th from 3.4 to about 2.9%. But it will take longer for an impact on mortgage rates, as banks have already priced this in, with typical fixed-rate mortgages already between 2.6 to 2.8% on average.
Okay, so firstly, the banks already priced it in, meaning that there was already a prediction or understanding that interest rates would drop. So banks were already probably, even in June, started lowering their rates in anticipation of this rate cut happening.
The last time interest rates were slashed were during the global financial crisis. As the global economy recovered, it took up to a year for mortgage rates in Singapore to drop by 1%. By that measure, it could be well into 2025 before significant impact on home loans are felt here.
In 08 was the last interest rate high, 08-09. So in 08, probably above 3%. By 2009 end year, 1.99, 2 years fixed was the package. And then in 2010, 1.88. So it took about a year to drop 1%. When interest rates start cutting, and then it will continue to fall, not just fall once, but continue to fall over a consistent period of time, interest rates will start dropping probably, I would say, first quarter, second quarter next year. That's where you see significant drops. I mean, today, interest rates are, let's say, taking an average loan size of about 800K to 1 million, 2.65, 2 years fixed. I would say by the end of next year, it should be closer towards 2%, slightly lower than 2%. And then floating rates are also accordingly going to be around that range at 2% by 1 year from now.
The Fed rate is also not the only factor influencing mortgage rates. In fact, in the US, mortgage rates have gone up since the Fed's first rate cut. That's because mortgage rates also track US Treasury yields. These have been on the uptrend recently as the US labor market shows signs of recovery, and inflation proves stickier than expected. That's made many to believe that rate cuts may not be as aggressive as previously expected. So banks will be watching out for indicators from the US economy to see if the cutting cycle will continue at the current pace or if it will slow down.
We want to see whether there are fundamentally any changes in the market or not. So like recently in the US as well, non-farm payrolls, the jobs being added to the economy is higher than expected. Unemployment rate fell just by a little bit. So those are all signs that the labor force in the US is still resilient. And I think the Feds are being very cautious about just wanting to slash interest rates. So these are things that we have to monitor, and these are the things that the banks are looking out for as well. Because the only thing that we know is that in today's market, change is the only constant, right? The Feds can cut interest rates today and slash interest rates tomorrow. But if data comes out of the market, it's very different. We can just reverse the decision overnight, right?
With so many uncertainties still ahead, should you wait for rates to come down further? If you're buying a home, analysts caution that lower rates often stoke buyer demand, and that can raise property prices.
Because you can go into a fixed interest rate at 2.7% today. Maybe tomorrow it might be 2.65, but you can purchase a property at 1.5 million today. Maybe tomorrow it's 1.6. Plus, it's not just, okay, if prices go up from 1.5 to 1.6, it's not just paying $100,000 more. People always forget that you have to pay buyer's stamp duty. So when prices increase, you pay buyer's stamp duty on that higher price as well, which means more cash outlay at the end of the day. So if you ask me generally, should I go into the market now or should I wait for interest rates to come down? I would say go into the market now, secure prices today, because in Singapore, at least, the trend for property prices is always on an uptick, right?
A fixed rate is also easier on the wallet, even if you anticipate rates to fall in the months ahead.
It only makes logical sense to be in a floating rate when it's dropping and then you write it down. However, today, floating rates start at 4% and fixed rates start at 2.7, example. So the difference of 1.3% is too huge a gamble in a sense to wait for it to drop.
Take, for instance, $1 million loan with a tenure of 25 years. At the prevailing variable rate of about 4%, you'll be paying $5,278 a month. At a fixed rate of about 2.65%, that drops to $4,562. So that's monthly cash flow savings of about $700 a month.
So what we suggest is to take a 1-year fixed rate or a 2-year fixed rate so that you secure the next 1 year of highs. You write out the drop, and then after the 1 year is over, you go to the floating.
So in the market, there are 1, 2, 3-year fixed interest rates. In my opinion, I think if you expect the interest rates to come down, then a 3-year fixed interest rate may be too long, right? Somewhere in the middle is going to be a 2-year fixed interest rate, and banks are offering this thing like a free conversion, where you can actually move to another interest rate package after a year.
That's why it's important to make sure your package is flexible enough so that you have the ability midway to adapt to changing economic conditions.
Trying to time the interest rate market is like, it's like trying to catch a falling dagger at the end of the day. There's only so much that we can do to try to predict or forecast when we should move. And sometimes it's not even your choice, right? And things can move in an instant. Inflation numbers can start going up again. We may see the Fed take a longer time to bring interest rates down. And if you're stuck on a variable interest rate and the Fed suddenly pause the interest rate cuts, you'll be caught in a bad place. So I think if it's anything, we just leverage on the lower interest rates that the banks are giving us for fixed interest rate packages now, and then wait until 2 years where we have clarity, and then we move again.